Introduction to Accounting. Accounting is the systematic process of recording, analyzing, and interpreting financial information about a business or organization. It plays a crucial role in decision-making, resource allocation, and performance evaluation. Evolution. Accounting has evolved over centuries, from simple record-keeping methods in ancient civilizations to sophisticated systems used in today's global economy. Its evolution is marked by advancements in technology, regulations, and business practices. Methods. Accounting methods vary depending on the needs and size of the organization. Common methods include accrual accounting, cash basis accounting, and hybrid methods that combine elements of both. Types. There are two main types of accounting: financial accounting and managerial accounting. Financial accounting focuses on providing information to external stakeholders, such as investors and creditors, through financial statements. Managerial accounting, on the other hand, provides information to internal management for decision-making and planning purposes. Meaning and definition. Accounting is often defined as the language of business because it provides a standardized way to communicate financial information. Its primary purpose is to measure, record, and report financial transactions in a format that is understandable and useful to stakeholders.
Users. The users of accounting information include internal stakeholders, management, employees, and external stakeholders, investors, creditors, regulators. Each group uses accounting information for different purposes, such as decision-making, performance evaluation, investment analysis, and compliance. Uses. Management uses accounting information for planning, controlling, and decision-making purposes. They rely on financial reports to assess the company's performance, allocate resources, and set strategic goals. Investors use accounting information to evaluate the financial health and profitability of a company before making investment decisions. They analyze financial statements and key performance indicators to assess potential risks and returns. Creditors, such as banks and lenders, use accounting information to assess the creditworthiness of a company before extending loans or credit. They examine financial ratios and cash flow projections to evaluate repayment capacity. Regulators and government agencies use accounting information to enforce regulations, ensure compliance with accounting standards, and protect the interests of the public and investors. Importance. Accounting is important for several reasons. 1. Decision-making. It provides relevant and reliable information for making informed business decisions. 2. Transparency. It promotes transparency and accountability by disclosing financial information to stakeholders. 3. Performance evaluation. It helps evaluate the financial performance and efficiency of a company over time. 4. Resource allocation. It assists in allocating resources effectively and efficiently to achieve organizational goals. 5. Legal compliance. It ensures compliance with accounting standards, tax regulations, and other legal requirements. The characteristics of accounting are as follows. 1. Accuracy. Accounting information should be free from errors and reflect the true financial position of the entity. 2. Objectivity. It should be based on verifiable evidence and not influenced by personal bias or opinion. 3. Completeness. Accounting records should include all relevant financial transactions and information necessary for decision-making. 4. Relevance. Information should be pertinent to the needs of users and capable of influencing their decisions. 5. Reliability. Users should be able to rely on accounting information to make informed decisions. It should be free from bias and faithfully represent the economic reality of the entity. 6. Consistency. Accounting principles and methods should be applied consistently over time and across different periods to ensure comparability. 7. Understandability. Information should be presented in a clear and understandable manner, even for users with limited financial knowledge. 8. Timeliness. Accounting information should be provided in a timely manner to be useful for decision-making purposes. 9. Materiality. Information should only be included if its omission or misstatement could influence the economic decisions of users. 10. Neutrality. Accounting should be neutral and free from any bias or conflict of interest, providing information that is fair and unbiased to all stakeholders. The popular boards that regulate accounting rules and regulations include 1. Financial Accounting Standards Board, FASB. FASB is an independent, private sector organization responsible for establishing accounting and financial reporting standards for public and private companies in the United States. 2. International Accounting Standards Board, IASB. IASB is an independent, international organization that develops and promotes international financial reporting standards, IFRS, to be used globally. 3. Securities and Exchange Commission, SEC. SEC is a governmental agency in the United States responsible for enforcing federal securities laws and regulating the securities industry, including oversight of financial reporting by public companies. 4. Public Company Accounting Oversight Board, CABE. CABE is a non-profit corporation established by the Sarbanes-Oxley Act of 2002 to oversee the audits of public companies and ensure compliance with auditing and reporting standards. 5. Generally Accepted Accounting Principles, GAAP. GAAP refers to the set of accounting principles, standards, and procedures that companies in the United States must follow when preparing financial statements. It is primarily established by FASB. 6. International Financial Reporting Standards, IFRS. IFRS is a set of accounting standards developed and maintained by the IASB for use in the preparation of financial statements by companies worldwide.
Limitations of accounting include 1. Subjectivity. Accounting involves judgment and estimation, which can introduce subjectivity into financial reporting. For example, determining the useful life of assets or estimating the allowance for doubtful accounts involves a degree of subjectivity. 2. Historical cost basis. Financial statements are prepared based on historical cost, which may not reflect current market values. This can result in discrepancies between reported values and the true economic worth of assets and liabilities. 3. Complexity. Accounting standards and regulations can be complex and may require specialized knowledge to understand and apply correctly. This complexity can make financial reporting burdensome and increase the risk of errors or misinterpretation. 4. Non-financial information. Accounting primarily focuses on quantifiable financial information and may not capture important non-financial factors such as employee morale, brand reputation, or environmental
Skills of an
impact.
accountant. 1. Financial reporting. 2. Accounting software proficiency. 3. Attention to detail. 4. Analytical skills. 5. Numerical aptitude. 6. Problem-solving skills. 7. Critical thinking. 8. Organization. 9. Time management. 10. Communication skills. 11. Ethics and integrity. 12. Compliance knowledge. 13. Taxation expertise. 14. Auditing skills. 15. Financial analysis. 16. Budgeting and forecasting. 17. Cash management. 18. Risk management. 19. Data analysis. 20. Interpersonal skills. 21. Adaptability. 22. Decision making. 23. Research skills. 24. Presentation skills. 25. Teamwork. 26. Strategic planning. 27. Project management. 28. Client relationship management. 29. Continuous learning. 30. Problem solving. Thank you. See you in the next video.